Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. There's growing talk of an interest rate hike this year following a jump in annual inflation to 4% on Wednesday. In fact, financial markets are pricing in a 1 in 3 chance, or even a bit more, of a rise in the official cash rate at the August meeting of the Reserve Bank Board. So, is it going to happen? Warren Hogan has one of the best track records on predicting rates. He was the only economist to predict a year out that the official cash rate would hit 4.35%. He's also one of the first to say that if there was an interest rate cut coming, it wouldn't be happening this year. That's all proved very prescient. Warren is Managing Director of EQ Economics and Economic Advisor at Judo Bank, and previously, of course, the Chief Economist at ANZ. Warren, welcome back to Fear and Greed.
Fantastic. Thanks for having me on the podcast again, Sean.
Will we see a rate hike in August? And if so, why?
Yeah, unfortunately, it's looking very much that way. What we saw with this week's monthly inflation number was not only further confirmation that inflation's not falling, and of course, we need to see it continue to be moving downwards, even gradually towards their target. But actually, we're now starting to get evidence that it could be picking up a little bit in 2024, confirming a few other bits of data that we've seen that are showing an improvement in demand in the economy, and the employment numbers are the big one there, where we've had incredible employment growth. So what we now have is a fair bit of information on prices in the June quarter, and it looks like that quarterly number is going to struggle to be less than 1%. And I think most economists accept that 1% increases in core inflation in particular in a row is essentially the trigger for the RBA to go in August, as articulated by Michelle Bullock in recent public comments, including Senate estimates.
Why aren't higher interest rates working? You mentioned the labour market there, but maybe you can expand. We've been told that if rates go up, the steam comes out of the economy, and it certainly looks to have come out of households and consumers, but it doesn't seem to be working, or at least not enough.
Yeah, I mean, obviously a very complex story, but the sort of the nub of it is this downturn is unique in that it's all been because of pressure brought to bear on household incomes. And of course, that's seen consumers respond by pulling back on spending. So that's the game plan working. The next phase, which we needed to see play out this year, was that weakness in demand impact business. And what we would have seen, or should be seeing, is these cost pressures that are in the economy not being able to be passed on to final prices because of the weakness in demand. That would hurt business profits. They would pull back on investment and hiring and sort of keep that inflation coming down and keep that softness in the economy while avoiding recession. But what we've seen is an improvement in business activity this year, best highlighted by the employment numbers, but also the PMIs for Australia, the Judo Bank sponsors, have improved. And of course, now we have evidence that the implication is that businesses have been able to pass on these cost pressures, and inflation is remaining sticky and potentially could be rising. So look, it's a very unusual economy, but the reality for the RBA is that every time they sit down, they have to ask themselves the question, is the current level of the cash rate going to ensure price stability in this economy? Now, they do that every time for the last 30 years. Right now, the issue is not only is it going to ensure price stability, but is it going to get inflation down to a level consistent with price stability, i.e. 2.5%? And the RBA has shown extreme patience. You know, we saw the stronger inflation numbers in Q1. They talked about a rate hike at the May board meeting, but said no. We saw the stronger April figures. They talked about a rate hike in June, but said no. We've seen this May number, and I think by the time we sit down at the next board meeting in August, they will have had a higher Q2 CPI as well. So they can't, their patience can't last forever. And the reason is, the reality is that the most damaging thing that's happening in our economy is inflation. That's what's hurting everyone. And rates, of course, are hurting certain segments, particularly certain households. But the RBA cannot relinquish their responsibility to get inflation down because certain segments are under pressure.
But that's a bit unfair, isn't it? It's sort of younger homeowners as opposed to older Australians who have paid off their homes, they're the ones being hit by this. I get monetary policy is a blunt tool. Surely fiscal policy needs to play a bigger role in it or something. Like, it just seems that the heavy lifting is being done too much by the monetary policy, and I don't particularly want to make it political, so just park the politics of it. But
yeah. I mean, I think if you look at the fiscal policy, and obviously we've got this cost of living support coming in, the tax cuts, and from the federal government perspective anyway, that was all formed up earlier in the year when it looked like we were on track. And it looked like the economy could be quite weak and that this support would be welcome and useful. But it's diabolical for Treasurer Chalmers. But between the times when they were thinking about this in February and March and basically the time of the budget, the whole thing shifted. And now it actually looks like this fiscal injection is coming at just the wrong time. But to your point, if they knew what they know now about the resilience of the economy and the stubbornness of inflation back when they first got into government, the very interesting question is, would they have done things differently? Because I think what we've seen, and I've obviously been right at the forefront of this, is we've underestimated not just the inflation, but we've underestimated the resilience of the economy. And I think if we knew this, then they might have done a few things differently on fiscal policy. But, hindsight's a wonderful thing, and we have to deal with what we've got.
So you talk about a unique economy, the resilience in the economy. How much of that is the fact that people saved lots of money, tens of billions, hundreds of billions of dollars, in fact, during the COVID pandemic? They've been able to run that down. It sounds like from the big banks that that's kind of run down now, and the official figures suggest that. Is there a risk then, if that's a major part for this resilience or uniqueness, that we suddenly really hit the wall big time if the Reserve Bank lifts rates, no one's got any buffers to call on, and the economy slows extremely quickly?
Look, there's no doubt that that's a risk. I think it's reasonably modest and obviously has to be weighed up against the risks on the other side. But my understanding is we had excess savings of over 300 billion, which is one of the biggest relative accumulations in the world during the pandemic. And my analysis of both the APRA deposit data as well as the household saving rate numbers is that we've probably run down about a third of that. But of course, a lot of that's sitting with people who the buffer's irrelevant because they've got so much money anyway. So we don't know, but we also don't know if we're close to the edge. But there are other unique features. The demographic shift with the final retirement of the baby boomers is completely underappreciated in terms of its core impact on the economy. And that is, just thinking about it this way, all of those baby boomers have just left the workforce and they're still spending, but they're not producing. So we have got a major imbalance in our labour market, and that's not going to go away anytime soon, but it's actually playing it's a structural issue, but it's playing a cyclical role because it's keeping demand in the economy. But look, the sad reality is, and Sean, you've seen these economies for a long time, as have I, is that this is all about the least bad outcome. There is no good outcome when you've got a serious inflation. And so it's all about weighing up that risk between the inflation and the damage it can do both short-term and long-term versus the potential risk of really hurting the economy. And as I said, we've all underestimated the resilience of the economy. And then I think the evidence in the labour market anyway is showing that I would never put in these rate hikes, which I did back in April, if I thought it was going to push the economy into recession. And I just think it's a risk worth taking. And I think now it's the RBA is probably going to take that risk. But remember also, they can reverse course very quickly. Yeah, they can start cutting very quickly.
Yeah, I mean, you said the least worst outcome. I think it's important to remember that the Reserve Bank isn't deliberately hurting people. It's just actually trying to get the best long-term outcome.
Oh, definitely. And this is the message when I'm going around the country talking to small, medium-sized businesses. The message is just remember those people at that RBA board, plus the senior staff of the RBA, they have got this country's best interests at heart. And they are trying to do the best thing for this community over the medium to long term. And at times, of course, we can't get away from the fact that we sometimes have to make difficult decisions and have a tough patch. But we've seen in the past how well rewarded our economy is by going through things like economic reform. I mean, that economic reform of the 1980s was so disruptive to labour markets and industry, but we did it and we have massively benefited from it. So, yeah, I think that's an important point to remember. And, this is so-called experiment where they're trying to sort of put us more weight on employment. I mean, Michelle Bullock made the point when she first got into office as governor that the best thing they can do to maximise employment in this economy and this country over the longer term is to keep inflation low and stable. I mean,
Yep.
we've seen the benefits in the last 30 years of what low and stable inflation brings to an economy. And I think we underestimate the damage that inflation can do to the health of the economy over the longer term.
Warren, what about the next 12 months? So let's say there is a rate hike in August or soon afterwards. Do you think that'll be enough? Am I asking you how long's a piece of string? What's the prognosis?
Yeah, look, I think part of the framework here is that it actually probably looks like our interest rate needs to be well above 5%. And not that I think they'll go there, but that'll motivate them to at least take it to, one or two more hikes. Now, the key issue for me is just what this tax cut and cost of living support will do. If, as some are thinking, it is going to be saved and only be spent by those in most need, then that could well be enough, because the reality is that we are seeing interest rates start to get up to that restrictive level. We're now getting the interest rate above inflation, and we're starting to get real rates higher. So, look, I still think there is a narrow path. In fact, one of the things that I think people misunderstand is the narrow path doesn't mean no changes to the interest rate. It's all about changing the interest rate to stay on the path. But one thing I am deeply worried about, I don't want rates to go up. I've got a mortgage, but I also have two daughters. And what worries me for them is that if we don't get on top of this and then we have to jack rates up big time in late 25 or in 26, then we saw it in the early 90s, what it did to our economy. We had 10 years of economic reform prior to that recession that gave us great tailwinds to recover. I don't believe our community or our economy will recover as well as it did in the 1990s if we go through that again. And another point on that, and I think it is important to note, is we're talking about the price of credit and whether it's high or low, the interest rate. The availability or the quantity of credit in our economy is abundant. And that's good. But what you don't want to see, which is what we saw in the early 90s recession, was a credit crunch. When the banking system stops supplying credit to the economy, that's when good businesses fail and people lose jobs that had good jobs. And we've just got to avoid those outcomes. And if that means that we have output growth a little lower for 12 to 18 months to mitigate that risk, I think, most people would take that payoff. And that's really what the RBA is doing. And it's tough, but that's why they're independent. We've learnt these lessons before, but unfortunately it looks like in some parts of our community, the lessons aren't understood or learnt.
Warren, thank you for talking to Fear and Greed.
Fantastic. Thanks, Sean.
That was Warren Hogan, Managing Director of EQ Economics and Economic Advisor at Judo Bank. This is the Fear and Greed business interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.